Hey, listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available? Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is May 1st, 2025, and today on our call we have the CEO, Shawn Wilson from BILD Direct Technologies. BILD Direct trades on the Toronto Stock Venture Exchange under the symbol BILD or BILD, without the U, and it also trades on the OTC under BDCTF. The company is currently trading at $1.46 with 42 million shares outstanding, or about a $61 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Shawn, great to have you here. BILD Direct's a company, as we were saying just before we went on air, BILD Direct's a company we've been following for a long time, but you're relatively new to the company. Yeah, definitely looking forward to hearing kind of what the story's all about and what things look like going forward. So why don't I hand it over to you and let you start your presentation?
Yeah, sounds great. So kind of get started. Myself, I've been in the flooring industry for about 20 years and am absolutely in love with the industry. It's a massive market. In my opinion, very stable. Not really tied to too many different cycle drivers. And for us, what we're doing now with Build Direct, which has been around for quite a while. I came on to the scene with the company close to 3 years ago now. It's been a lot of fun. So kind of first and foremost, for those who are new, we're effectively a consolidator for the North America flooring market, which we'll talk about a bit. For us, we think about things really from a payback perspective, whether we're building a location, buying a location, or launching new product categories, things like that. Our team is very much focused on that mindset. It's not about what you build, only it's how you do it. It's a huge part for us. One of our favorite phrases internally is at what cost, which is great. With us, we're huge on asset coverage for our investments on pretty much everything we do. And right now we have 9 locations plus our e-commerce location, which is where I'm located now in Vancouver, and looking forward to growing across North America. When you look at our performance and really where we're focused, the initial TAM, like the initial market for us, is North America flooring, which is around 90 billion. But then also there's adjacent categories which the company was involved with previously, and also looks to explore really the after flooring. Flooring for us is kind of first and foremost. The reason why is it's a huge TAM. It is unbelievably still fragmented. If you'd have asked me, like, on this business, I had long blonde hair. It was amazing. How fragmented it'd be 20 years later. I would not have guessed that not much has changed. You still have around 12,000 independent retailers. A very small amount of the industry is online, and on the big box side, I don't know, it got up to estimates around 24, 26% in that range. But for big box retail, this is a tough category for sure, with only a couple exceptions. So really, when you think about like who we're competing against, it's really a mom and pop retailer, a local business, and then for us, we are our current size already in like the top 20 in the industry. So it's a pretty good opportunity for consolidation for sure. Flooring in general. So I grew up, kind of during the first crisis of my career, which was the housing crisis. It's been quite a few now since then. Seems like almost daily. But with that, love like stable industry that you can really grow and flourish. I'm not huge on a lot of volatility. And so when you look at the flooring industry, first off, it's required material. Every home needs flooring of some sort to occupy, both legally very often, also from a comfort perspective. It's one of the only things that you put into your house that you actively destroy with your kids, family, pets, so on and so forth. And then I should mention about 65-ish% of flooring is tied to just residential remodeling, just things wearing out, uglying out, things like that. And a much smaller percentage of the industry is tied to like new construction and building. And people think that a lot, like cabinets, countertops, roofing, siding, things like that are much more tied to the building cycle. Whereas, flooring is not. It's furniture for your floor. So there's, part of it that's tied to that, but really not close to the majority. For us, we're in every category in flooring. We also offer some services. So things like local job, site delivery, commerce services. We do a lot of other B2B add-ons for our customers, really to help build out like a back office for the pro customer, whether it be doing takeoffs for a large general contractor or helping work through installation problems locally, with a contractor doing a project. Our team is, effectively expert in the space. And for a pro, they really leverage our model because it fits their business model very well. When we say pro, we're referring to the categories listed, like the marketing costs for attracting them is much lower than a homeowner. Like, for example, I'm a huge fan of Floor & Decor, love their model, $10 million, get you a new store, 2-year payback, but it's really at the homeowner. And so you have high marketing costs associated with it, like Class A real estate plus all the marketing expense to supplement it. And then for us, we build our model off of just that pro customer, the customer who doesn't want this massive building to walk through, but rather wants to have a quick phone call or go on our website, order something and pick it up in 10 minutes by backing their truck up and be gone. Within 5 minutes. Like, our model is built for that. Even on inventory, so we don't talk about inventory on SKUs in the in the hundreds of square feet or meters. It's thousands. And so that's how I kind of can think about us when it comes to who we serve. Effectively, it's about a third B2B, so mom and pop retailers, a third contractors, and then large projects, all the way from hospitals to schools to renovating like local malls. For us, I mentioned before, it's all about the return on what we do. We're running the company in a way where we're consolidating, but we're doing it in a way that we think is pretty unique. And that play looks like this: our pro centers, which is what we're modeling out. Kind of first and foremost, it interacts with our e-commerce business, which I'll talk about here in a minute. But these are very simple, straightforward operations. 20, 30,000 square foot warehouse. We lease the warehouses. Very minimal cost renovating them, getting them ready for operations. We can move and grow relatively easily there as well. And so for us, it's all about building out this pro center footprint, which will be really a way to model out our growth here in the future. Today we have locations listed here, so a total of 10 locations. One of those is our e-commerce location, which is in Vancouver. And then the rest, California, Michigan, is where we got started on brick and mortar. Just acquired one in Orlando, which we'll talk about. And as you can see, we have quite a lot of real estate here of dots to fill in. So how we enter into a market, we think is pretty great. And this is also kind of leveraging past experience in e-commerce and candidly at points doing things the wrong way. Nothing's like a lesson learned there. So for us, we enter into a new market with e-commerce first. And so, for example, in LA, we're very active in that market before we built a pro center. And then in Orlando, the same thing. And we have a hit list of markets across North America that we're actively focused on to build up a base of business as we're kind of skimming the market. And then from there, it's pretty straightforward. Like in LA, we were skimming the pro market, fulfilling orders relatively efficiently, but from out of area. So it's a profitable model, but you still have the inbound shipping cost to service out of area orders. And once that shipping cost, once it gets to a point of where it's pretty close to what rent would be, maybe a little more than that, for dropping in a pro center, then we go into to build or buy mode. And for us, it's just math. If we could find the right place to buy and renovate, fantastic. If not, we build it. We prefer buying because you have a good jump start into a market, but we always compare it to the cost of building to make sure we're staying within our return expectations. From there, we ramp up, and the optimization for the pro centers is very straightforward. We have really two hard synergies. One is on the procurement side. The vast majority of the industry does not direct import. It buys through mid-market distribution. So we import, we have pretty great improvement on COGS. And then secondly, we are pretty good marketers because of our e-commerce business. And so we're able to layer on marketing as well. So for us, whether we're building or buying, there's a pretty good roadmap for that. At this point, as I mentioned before, we have demonstrated two builds, one in Richmond and one in Los Angeles, and then the buy would be most recent one was the location in Orlando, which I'll talk about in a second. And then for us, you kind of like think about our company. We have our corporate like platform, the entity that is executing this play on the build and buy side and operating on the TSX venture exchange. And then we have our operations, and our operations have a great double-digit return. And as we scale, that corporate platform cost is relatively fixed, which is great, tons of leverage. And as locations grow, it just gets better, better, and better. And so that's really how I would think about our business and kind of model it. For us, e-commerce is also a very healthy business. And so I kind of view it like a location, but it's not geographically, obviously bound. And so we operate today in around 22 like main markets. And there's really nowhere we can't ship to. We just kind of prioritize markets we want to eventually have a physical location in. So the last acquisition that we announced was Anchor Yorkshire. So there are two brands, one business. In the pro focused arena, local brands and regional brands are really important to pros. And so, like in this case, the business was acquired by BILD Direct. It will be rebranded as BILD Direct. Yorkshire, Anchor are two brands now that will continue to service in the market. This business was doing around 6 million in sales. EBITDA is listed around 6.5. And then when you look at inventories, close to 600,000, and we bought it for 593,000, which was the cost of inventory. And then for us, it was a very quick 4-week integration plan. And then from here, we have a few categories to bolt on to the acquisition. So our roadmap for that business is first integrate, bolt on a few different additional customer segments that they were a little light on. And then like every opportunity, you have some learnings that flow backwards as well. This business was very well positioned in the hospitality and medical areas. And so it's a pretty good one for the team. On this side, like, very, very solid results on, regearing the platform and producing a record of positive EBITDA. And as I mentioned before, like when you look at our company, when you peel out the corporate platform, it helps kind of give a view of what EBITDA looks like. And we are kind of first and foremost focused on that because that's, EBITDA translates or can translate into free cash flow. Free cash flow can be reinvested, and that's really what we're focused on. We're very tightly inside held, very tightly, so 78%, and the other 22 is a short list of folks slash funds. Very short list, very tightly held. Great, inside family offices who've been involved and very instrumental in the company, the turnaround, and what we're really doing next. When it comes to comparables, I think of things like ABC Supply. It's a roofing company. It's not on here. It's hard to really find a direct competitor. But Ferguson's a good example. And then in the flooring space, I have a couple of examples on here. But they're really homeowner focused. They have high marketing costs. Great companies, but not exactly in our same deal. So solid team and fantastic board. So with that, love to take any questions.
Awesome. Thanks so much, Shawn. Reminder, everybody's listening, as usual, if you've got questions you'd like me to ask Shawn, please use the chat function and we'll do that. It's a pretty straightforward business. You are aggregating, let's call them succession issue type of businesses, typically mom and pop by the sound of it, and gaining buying power and stuff like that. Maybe is there some additional synergies maybe we haven't touched on? Is there anything else that you can think of? When I think of sort of a mom and pop operator, they tend to, when they go to sell something, they tend to sort of ignore maybe best business practices or investing in the business going forward. I mean, are you guys able to take advantage of that sort of stuff?
Yeah, so yeah, this one's pretty interesting because like there's synergies that are not as apparent. So we could ask like, hey, how do you facilitate the deals that you do as a team? And there's a few pieces, right? Because there's always like the presentation, the view, but like the real life stories. And so, look, 20 years of cocktail parties, you meet a lot of people in the business. And the folks I met when I was in my 20s, 20 years ago, like they had moved on and they're now looking to retire. Like most industries, succession challenges have been just very rampant. It's always the same story. I mean, I won't give it on here, but it's always the same like sequence of events that happen. Beautiful business doing well, and then from there just can't find the right fit, or maybe they had like they had a family member take over and didn't quite work out or insert other solution. But there's two other things that happened that was really a wake up call for me to get the right team together, the right backing, the right vehicle, which was first and foremost, for flooring, if you have like a container of I'll be silly, iPhones. I was gonna say
Mhm.
eggs, but I feel like that one's too soon.
Too soon,
iPhones,
yeah.
there's like intrinsic value to to those phones. If you have a container of flooring, okay, what do you do with it? And there were quite a few examples out there where flooring has to be within a marketing context, like sample programs has to be flowing through.
Mhm.
Um, and so one big challenge is when it comes to these businesses, finding a broker and then listing their business. Unless you're strategic, that inventory how do you value it? Like
Mhm.
for us, when we digest the business, it's great. We have lots of channels to flow the inventory through, and they're all pro focused, but they're different, so we can maximize the value of that. The second piece, which was a shock to me, real estate. So if you are a pro-focused flooring business, that means you have inventory. If you have inventory, it's in a building. And light industrial real estate has done very well over the past very well over the past 15 years in a lot of these markets, actually pretty much all the markets. And so yeah, this company that might be doing 10 or 15 million dollars in revenue and maybe making seller discretionary earnings of I don't know 850 or something, the building's worth,
Yeah.
$19 million.
Yeah.
And what happens often is one, folks will, pay themselves like, below market rent, or even if they're not, when you go
Mhm.
to sell the building, the age of like owner occupiers is kind of over. You want to sell it to institutions and the cap rate's all wrong. So, a big part of it was like, hey, how can you harvest the business with the real estate being the big payoff? Let that be the windfall, let the real estate be the windfall,
Yeah.
not pay off in the business. The last piece I'd mention is I was going to these conferences every year. The main one surfaces in Vegas every year, same hotel, same elevator music. It's like a deja vu every time. And
Mhm.
more, first was like courses on how to buy better and how to market better, then how to implement X, Y, and Z. And now it's down to how do you sell your business? How do you get ready for that transaction? And here's like 35 things you have to do. Hire my company. We'll put in place a ERP, CRM.
Mhm.
You got to stop paying for your sister's car. Like all these things, it's not going to happen. Doesn't happen. That is so painful. And if I have a building worth $19 million, I just don't care. And
Mhm.
so for the most part, that was the part that hit me is, hey, instead of, putting people through that experience, we want to have like to be the easy button, right? So we have a great team. They're sitting around me here in their offices, and they come in and really help these entrepreneurs work through their business and work through the process without having to go through all those system upgrades and so on and so forth. However, with that said, the team's experienced, we've done this before quite a few times, and we know what we're looking for. And so for us, we prefer if there's not an ERP or CRM, we're going to use ours anyways. We assess everything not at book value out of a spreadsheet, but out of intrinsic value, what it's about worth to us within our makeup, and that makes us, I believe, a really good fit for these these entrepreneurs who just, want to have a nice, good exit without, kind of being, demoralized and kind of beat up on in the process. If that makes sense.
Mm-hmm. Shawn, I mean, I've got to imagine there's just tons and tons of opportunities in the space. How do you sort of filter through? How do you get access to these opportunities? Maybe explain a little bit of what the pipeline looks like going forward.
Yeah, so I'd say kind of first and foremost, our company-driven pipeline is our major markets that we're targeting. It's e-commerce first, and then that drives the focus for the company. And then from there, like outside of that, we have a pretty deep team, and we're pretty well known within the flooring industry. Like super famous in a very small pond, right?
Mhm.
And so with that, just candidly, there's not folks doing what we're doing in our space, and so uh, almost weekly inbound opportunities that flow in, not through brokers. We're not really a big fan of that approach, but rather through trade press and things like that, people seeing what we're doing. The last part I mentioned, this one's a bit maybe unusual. So I mentioned that we're B2B, we sell to mom and pop retailers, and I mentioned before a lot of these businesses buy from mid-market distributors. We have that function. A lot of our folks in our M&A pipeline are current customers of ours today. So when we say we know what the procurement synergies are, that's a big part of how. And so we have a multifaceted, quasi-organic stream of these coming through.
Mhm. Awesome. And then, how, I mean, what sort of financial position are you in right now to do more acquisitions? Or do you have kind of the resources you need? Are you looking for more? What can we see there?
Yeah, so I'll kind of give a long answer to this one. So for us, like the market was becoming ripe. So about 2 years ago, it's about 3 years ago, we started down this journey. About 2 years ago, we noticed businesses coming in, market getting tougher. Like there was a time when you had the COVID boom for remodeling, then you had PPP, ERTC one, two, all this like free money kind of hit, and businesses were getting back to normal-ish, and normal was never quite good enough for them because of what they were kind of experienced and used to, plus the cycle. And so from there, it's like one of those things where you just kind of wait. You have a good pipeline, we're nurturing it, we're pulling it through. Our pipeline is pretty mature. So we pull people in for sure, but we work through it as well. So I would say we built up a pretty good pipeline along the way, and we're doing that kind of strategically. Like for example, if rents are dropping, a little bit by every month, you just give it a minute to see where things kind of level. Can't catch the bottom, but just see where it levels out. With that said, at the same time, like a huge part for us was getting the proper debt facilities put in place. We didn't want not knocking it, but we didn't want like a creative debt stack. Don't like debt. Like creativity is not something we're a big fan of here at all. The financial side, it's just straightforward. And so like the Economic Development Canada is phenomenal for companies like ours. Like is such a business friendly place for our type of business. But with that, you have to run that through a tier one bank. And so for us, working through the process, posting up the great results, consistently splitting out the corporate costs, giving visibility there, so on and so forth was a really, really important part. And then with that, recently the next big catalyst we launched, one of the catalysts we launched was our RBC facility, which is a prime plus one. And then intuitively, that's step one. There's some other steps to get more facilities put in place using similar programs, through that side. So with that said, pretty much what we acquire can be bought using those types of facilities, which is what we like. We love doing deals where it's not like raising a bunch of money and then having a stopwatch on how fast you have to spend it. To me, is a recipe for disaster. Rather have facilities put in place you can transact with when it's perfect, when it's ripe. So you're quiet until you're not. Quiet until you're not super key. And then from there, if you need to dilute, like on the backside, one way or the other, you do it from a perspective of what you have, what you built out, and what's already kind of already there. So that's how we were approaching it. So long story short, like we look at the type of businesses that we buy and the asset coverage, it kind of leads towards, hey, you could use debt facilities to do that. And then, for us, you have to, maintain covenants, things like that, which are pretty conservative.
Mm-hmm. Now, the example you gave there was, an acquisition that basically cost you 1x EBITDA. Is that the norm? Is that the kind of pricing you're seeing out there? Or is that a bit of an anomaly?
Yeah, so it's definitely not an anomaly. So for us, like, internally, it's a path to 1 year payback, a financial plan for a two. Anything over two, let's have a conversation, which usually ends in no.
Mm,
But that's applied to, like, we run it like it's a fund, like that applies to everything
yeah.
that we do. And first person, I feel like if you build that into your culture, you have a lot of great things that can happen. So I would say no, it's not unusual. We look at like a size, like for example, if a location had, let's say, 10 million in sales, it's probably, one large location, one like, mid-size. But for the most part, it's that deal is kind of reflects the economics of it. But yeah, for us, 1 to 2 year payback is great. And I would look, mostly for us, it's heavy asset coverage on those deals. And
Mhm,
then it's assets here again that we have assessed the intrinsic value of, and it matches up to what we, like how you put the deal together.
mhm, mhm. And then, I mean, you touched on it a little bit. There's a renovation market and there's a new build market. I mean,
Mhm.
I imagine you address both, but is there one that's more predominant for you?
Yeah, so we're much heavier in the renovation market.
Mm,
I would say around 85 or so percent of our volume is all renovation tied, and then only 15% on um, new build / commercial
mm,
kind of things like that.
mm,
So we've designed our platform around that. So like you can index heavy into one and do very well in that one until the cycle ends. And being in the space for a while, you've seen that, right? The overall industry might have dipped,
mm,
or maybe growth slowed to 1%, but you know the builder segment was -20, and
mhm,
then the remodeling was up. And so for us, we're the only focus is the pro customer, the B2B, which is a mix
mhm.
of who I mentioned before. But
Yeah.
for the most part, we've have ourselves set up, for that diversification accordingly.
Gotcha. And are you seeing any other sort of industry trends? Is there something kind of that we should be watchful of? Or is there, new products that are getting people excited, new technology, anything? I don't know. It seems like a fairly resilient business and probably not prone to too much change.
Yeah, so I like to make jokes that I'm in the fashion business, right? Because flooring is
Uh-huh.
fashion for your
Uh-huh.
floors. I don't know. Look, not much has changed over the years. The most like innovative thing that happened in the space was, wood look tile. I remember that was a huge thing 20 years ago,
Mhm.
and now it's everywhere. You have like, you have like narratives and pitches and marketing.
Mhm.
Like when I was at Home Depot, I came out with the LifeProof brand. That was like my hallmark brand. And it was funny because like you're telling the story to people like, hey, this is the one of the biggest brands in decor. I had the LifeProof suit, made a carpet at my house in the attic. And but my biggest lesson from that wasn't it was a great brand. It was it's just marketing. But at the end of the day, it's just marketing. The
Yeah.
brand that mattered for that brand was the one above it. It was Home Depot.
Mhm.
Home Depot, that brand for a
Mhm.
consumer. We don't sell to consumers or pros, but I would say that's probably one of the biggest, kind of takeaways is very straightforward, very low, change. But we're
Mhm.
also not tied to manufacturing. So I would mention if there's like a huge shift to like a new substrate of flooring,
Mhm.
fantastic. We have no long-term contracts or tied down,
Mhm.
which is a lesson I learned while at Depot. Like be very selective there, and so we're in a good spot. So like for us, like when tariffs hit, things like that, we're diversified in where we source, and so that part's a really important piece. And also, I get asked, every now and then, will you ever backwards integrate? No. As a manufacturing for quite a while, and I do think that's where you can get hurt in this space when there is, some kind of big change of some sort, some sort there.
Mhm. You mentioned the T word, so I might as well bring it up now. The tariffs. What kind of impact are you seeing at all as you roll out your business?
Yeah, so I'd say first and foremost, so look, it wasn't because did not think it would be from tariffs. We thought it'd be other things, right? Like power outages or pirates in the water. I mean, who knows, right? So like for us, we have a pretty diversified group of suppliers in different countries, and we're just like mindful of that. Like we don't like concentration risk, if you can tell already, whether it be with like one key salesperson or one key customer or one key supplier. We don't need to be. We keep things diversified and focus on returns. And so with that stated, like that's been one really big piece for us has been that. And so we have some categories that are we believe will be exempt. I say believe because as of now they are, but tomorrow things change. But we have the ability to move things fast because we don't like source from our products are designed by us, specified by us, and factories produce them for us without long-term contracts. And so for some reason, location one doesn't work, you can move to location 2, 3, 4, 5, or 6. So the way we kind of like present it or talk about it is we don't think we'll lose any competitive positioning from it. We might end up in a better spot because of the flexibility, but the minimum, if anything, the only concern that I would have is just macro, because it's tied to flooring is a discretionary purchase, for the most part, aside from that, but it's relatively inexpensive at the same time, and people are walking on it every day. So that's my only concern on the tariff side would be more macro in nature.
Um, I guess outside of that, I always like to ask the question, what sort of keeps you up at night running the business? What challenges do you face specific to this business?
Yeah, so I would say, it's interesting. Like on the tariff side, not at all. One of the hardest things for me, like for folks that know me, the being patient and waiting the period to get the facilities put in place and really to do things the right way. That was a bit of a challenge. We were focused on the core business and really there. We have a pretty healthy incoming pipeline, and what keeps me up isn't really worry, it's more opportunity. Just love working through and kind of plowing away, but then also trying to make sure you're doing the right one in sequence and kind of things like that. So I don't know. I tend to be relatively low stress, or if I do have stress, I'll pick up on it. So maybe I have an issue there. But I'd say probably that the biggest thing is making sure you just are patient, working through things the right speed. And the saying we use sometimes is pigs get fat, hogs get slaughtered. Whether it's a negotiation or a deal or in growth as well. So you try to keep that in check as well.
Gotcha. I mean, as you guys, the capital that's coming in or the cash that's coming in, how do we look going forward in terms of what's your capital allocation strategy? Is there initiatives outside of M&A that you can deploy capital to?
Yeah, so a few, but not like they don't require a lot of capital. So I'll give you a couple examples. So for us online, we do a lot of wood. Wood's a great category, very high margin category. And we traditionally had a very small footprint of like wood and was around about 12-ish, call it, percent of the industry. And so we're allocating some capital to add those to our brick and mortar, and the payback will probably be, I don't know, 2 months, 3 months as we're scaling that up. Tile is another one. Tile is around 35 or so percent, very high margin category for the industry. And traditionally we were a bit light there. So we sell tile, but not a whole lot of it. That's a category we're starting to work through to pull in on our direct import side. But there again, yeah, effectively it's a pretty rapid payback, and we're pretty aggressive on terms. We have great terms from vendors. We like to think about product as being, doing deals that have a positive cash cycle. so they can grow without being too intensive. R&D, no. I mean, we did a lot of heavy lifting on the system side. There's some minor things that we might, do here and there, but nothing really huge. So for us, effectively, it's literally just build, buy, build, buy, build, buy, and anything else that we do, it's an afterthought or a rapid, almost a non-event on that side. So uh, that's how I would kind of think about us on the build and buy. Most of the cost on the build is inventory. Most of the cost on the buy is inventory, and very little expense when you do conversions.
Gotcha. Now, Shawn, I went through some of the news releases, and I noticed that just recently you guys have you announced that you've taken on a loan of some sort and relending that to insiders. Maybe explain a little bit of that and what the rationale is.
Yeah, so we're an interesting group. So sometimes I feel like our management meetings or our shareholder meetings, which is good, right? You want to have that. So like from a leadership perspective, you can check out our over time kind of who's put cash into the company, and for most part, our management team, we're not. It's not just. I don't want this to sound wrong, but like I don't know. I struggle when people are just incentivized by options. I want you know you want partners in life, no matter what you're doing. Like I believe in like this horizontal like structure of the world, which is a little unusual and kind of a rabbit trail I won't go down today, but like that's really a big part is having people pulled in, invested in their own cash in the company. And that's just one more extension of that. So past filings, you can see who's bought, who's participated in private placements, and so on and so forth. That's just one more deal there. So as announced, there was an incoming loan from a fantastic, very supportive insider that was willing to facilitate a deal and a buy there. And all it does is bring the team closer and closer together and align shareholder management shareholder interests as well. So I would say that's kind of like how we think about things and how we like to structure things. And if you're part of you're part of the team, that's how we view things, which is a little unorthodox, especially from like the big company perspective.
Gotcha. Well, perfect. Well, listen, we've got a handful of questions that have come in. Why don't we jump on those, and then we can sort of end with a few more questions for myself. A question here from Shawn. It says, for your business, is there a big difference between the rental versus market, I guess homeowner market? Which do you have more exposure to, if you know that at all?
Yeah, so definitely homeowner for sure. That's like tied to like renovation, things like that. That's like people fixing up their house. They usually fix up like, we call it 2.5 rooms at a time. On the rental side, we call it, we refer to as multifamily, and we do probably like maybe like a fifth of what we do on the homeowner side. That's multifamily. Typically, that's also like installed. And so if it's we do installation in a few areas for multifamily in particular, and then if otherwise we're just shipping product for GCs to install. So there's to answer your question more directly, more exposure on the residential remodeling homeowner side.
Yeah, that makes sense. Okay, Russell says, do you find some mom and pop stores have a concern for their employees when selling? Are you able to accommodate job security when you structure a deal?
Yeah, so that's a great question. So like for us, if we're doing a build and buy location, like look, we can lease buildings. We like our brand, great brand. We have great systems. It's really easy starting off with a fresh team on new systems, so on and so forth. For us, the value, like in the ones we've done in the past, it was all about the people. And that's not a sales pitch. It's just being, I guess, almost like just very direct. Like it's literally you're doing a deal. If I have, if I have $1 million of inventory, rather it be just new inventory I'm importing. We can value it and work through it and so on and so forth. But that's really what it's all about. And so we kind of start first and foremost there. And yes, like there's a lot of especially since they typically own their real estate and they've been in business for 20, 30, sometimes over 50 years, second generation, third. That's a huge concern. I'll say one thing. Sometimes there's not. And when there's not, it's a red flag, and we usually just delete, because there's no care or concern. Probably flows all the way through the deal. And for us, like what a big part I like to start off with is, I mean, when we do deal, first and foremost, we're protecting the existing shareholders and families we have kind of here. But yeah, a huge part of it, right? Like you're working through family dynamics and kind of things like that. And I don't know, like I get a lot of energy from that. I know Carrie, our CFO, does too, and Jay, our COO, as well. So it's a very big part of it for sure.
Shawn, I didn't take a look at some of the deal structures in the past, but do you ever get vendors that say, "Hey, I want stock, or at least some stock in a transaction to sort of
All,
have a little bit
all
of,
of
yeah,
all of them.
yeah, okay, good, good, good. That'd be a good sign for sure. Yeah, yeah,
Yeah, yeah, no, for sure. So yeah, all of them. That's the short answer.
yeah, fantastic. Yeah, awesome. Okay, Hassan has a question. It says, "How do you build and maintain relationships with your key customers or clients?"
Locally, for first and foremost. And so we run a decentralized operational model. So our
Mhm.
platform is very lean. It'll always be lean. I'm a huge fan of like a holdco format. And so, like for example, if you're running one of our pro centers, you own the relationships with the customers, major customers. You probably created them, you've nurtured them. We're here to help convey and add value if we can from like a company efficacy perspective, but we're very mindful to keep the ownership of the relationship local, for sure. Otherwise, you run into bloated corporate platforms and people on planes, right? So that's not really our speed.
Do you always change the name, or do you ever keep the sort of the local name since it sort of carries some brand awareness with their customers?
Yeah. So we kept so the first two acquisitions we kept because their brand was extremely strong in the local market. One was Floor Source, a very well known name in that market, and the second one was Superb. And Superb is a good example where the Build Direct brand is stronger. There's a sub brand, and so for example, you can think through that one like Superb, Build Direct company, and co-branded together. And so for us, when we're doing the assessments, we either model it as a like a bolt-on subsidiary or a buy and renovate, and then that from there, if we keep, which we almost always will, we'll usually keep their business name and you subordinate it as a brand. And we have that in our matrix as we're trying tracking them along. That way you get best of both worlds. You have it owned by a new company, but you have continuity of the brand, and then selfishly for the team as well, you have a lot of samples and active business, so on and so forth, that's already out there, you're able to keep able to maintain.
Yeah, yeah, definitely. Okay, Tarek asks, what percentage of growth do you anticipate will come from building new locations versus acquiring existing businesses?
So as of now, I think most of the growth will come from acquiring and integrating, I would say, based on where we are in the cycle. If something changes and things become really expensive for some reason, then we just shift into build. And so yeah, that's kind of how I see things right now. But I think I don't know. I don't the opportunity we saw on the buy side wasn't from like all the recent economic noise. It was before that. It's only gotten stronger. So I think there's a quite a few years of opportunity there. But here again, if it's not, then we just shift back into build mode and go from there.
It seems like such an exercise of just using your calculator to figure out where the return is. I don't want to say it's simple, but I'm sure it's hard work, but it's simple in practice, I guess, in decision making here. Okay, listen, Russell says, do you have an end game? What's you look out 5, 10 years, what happens to the business?
Yeah, so I'd be thrilled if we had like 75 locations, 100 locations. I'd be thrilled, and then by then, somewhere along the line, there'll be adjacent categories that would have come up. These different businesses, not always, but enough times have other categories where it's a similar customer. Like our pro isn't just like a flooring pro. Very often they're more of a GC. So there's cabinets, countertops, doors, trim, all the stuff inside. And so when you look at kind of like filling out the matrix on what that pro center footprint looks like, that's how I kind of think about it. So, real estate grab first, land grab first, you're building locations out. but then from there, like tapping into the larger 200, or some odd billion-dollar TAM of the adjacent categories, is really, is really there. I do think we're pretty attractive for a strategic on what we're building. Where our real estate profile, our branding, our positioning, our modeling is very lean. I think people make mistakes when they think really big companies have lean supply chains. It's not the case. Not the case always, at least. But like just from my perspective, there's not. Yeah, I don't know. I'm in my early 40s, and I just love what I do. So if I wasn't doing this, I'd be doing this.
Yeah.
That's kind of my viewpoint.
Yeah. Lots of time to go here. Yeah. Okay. Nick says, a friend of mine recently purchased flooring in Northern Florida from a local pro source via a contractor who helped him make the purchase. I noticed that they serve locations in different parts of the country. Is there anything that significantly differentiates you from ProSource and any other similar companies with scale that also focus on professionals?
Yeah, that's a great question. So, ProSource is a franchise. It's a buying group, and so that's owned by an independent retailer. They might own one, they might own, a handful. Very unusual to own more than like three or four. So it's a franchise, and so they pay a fee on the products they buy, like a rebate fee that gets loaded in, and then typically like monthly or quarterly fees on top of that, into like a buying group headquarters that handles like branding, vendor negotiations, so on and so forth. Um, so like in that model, we're an example of a supplier. Those are like the kind of people that we supply. Now, if we have a pro center in the area, are we competing as well? Probably not. Like a pro source, they're working with designers and like, big design projects, so on and so forth. Often they're, farming out installation. Whereas like for us, we're that company in town or shipping from out of town on the actual product itself. Maybe we're actually doing the takeoff work and kind of feeding it in. And so that's a great example of, I love the flooring industry. You have like that Carpet One, Abby, and they're all just franchises. And in that, I mean, geez Louise, even like big box retail, I would say for today, they are an example of even a customer for us. And so for us, we that's kind of where we fit into the market.
Gotcha. What key performance indicators do you typically prioritize when evaluating success?
Yeah, so when it comes to a few minutes ago, you mentioned it's probably just a calculator and a pretty simple play. And I'd be honest, it's not complicated play. It's like, each day getting up, doing my little workout and the run. It's not complicated, but it's so hard, especially when it's cold outside. Like you have to have that consistency. And so I would say kind of first and foremost, on the like the number one thing that I just, try to stay focused on personally is capital allocation. I think that's the number one thing that, frankly, all CEOs, like, you have to obsess over that. And like myself, I came up through operations in my career, then entrepreneurship, and I can lean back into ops at times because I index there. And so we have all the standard e-commerce and brick and mortar ops, KPIs and things like that you would imagine. But for me, first and foremost, it's literally, okay, we made these past investments and we're updating how we've done, and we're treating them like our corporate. This might sound terrible, but our corporate platform is like the fund manager, that cost, and how is the fund manager done on the different investments that it's produced. So some KPIs are how much cash is flowed back to the platform from that, how much are we holding from that there. And really, if you just, at least for me, like you stay focused there and never lie to yourself on, oh, that's producing some synergy, insert other buzzword. That's really what I focus on, just more than anything is what'll be, whether it's acquisition or new product launch or a marketing campaign, what do we spend, what do we get, what do we learn, rinse, repeat, move on.
Gotcha. Okay, with such little capital expenditure requirements, how does the company view share buybacks as a channel for capital deployment?
Yeah, so well, so first I would say there's been a lot going on in the company, like a lot of work and a lot of great things. We've been in blackout a lot. So I'll kind of first say that. So even like we're not in like your normal blackout, there's been quite a few times where we are. And so, we're very respectful and, really kind of conditioning ourselves on running a really great pubco function so that we can grow in that regard and be trusted with that approach. And so I would say, look, the way I view it, both within the company and outside, like, uh, there's an intrinsic value to the company. Set it like personally within about a month of being here on what it was. And then from there, like any kind of allocation decision, if you can, spend a $500,000 and get an outsized return against an intrinsic value, then fantastic. So I would say, that's kind of how we think about it. Not that there's much of a float in the first place, though, right? Like, I mean, I mentioned before, we're 78% inside held, and I could probably list where most of the balance is almost on a single hand, for a lot of the major chunks. And so I think that's more of a question for the future. Um, and that's how we think about it, for the future.
Yeah, no, fair enough. Okay, does any enterprise in the US or internationally maintain a similar strategy and perhaps is at a more mature stage of business growth? So a reasonable company to case study as trying to better understand Build Direct's possible evolutionary direction. Do you know of
Yeah,
any
so
bigger comps?
I would say for flooring I don't. However, for the category, I would say ABC Supply is a company that we adore. So they're in the roofing space, ran a very similar play. You can go back and look at their multi-billion dollars now. Like look back at their play, and that's a really good example of staying rifle focused, pro segment, very similar strategy on location growth in that regard. So I'd probably say that's probably the best, the best or closest one. In the flooring industry, so the Platinum, I'm probably saying this wrong, but the Platinum Group did a roll up with the Artisan Design Group in flooring. They recently exited that position to Lowe's. Went very well. Went very, very well. That business though was a bit different. Like they do full service installation, like design services and installation for like commercial projects. So I mentioned before, like 15 or so% of our business is in that space. They're closer to like 80%. And so great build, great example of what a strategic will pay for that type of business because you just is the real estate's different, the service model is different, so on and so forth. But yeah, it could have been a different story. There were some ups and downs because it was so concentrated on the cycle. But the last one I would say is maybe an HT Supply. Um, it's a supply company depot, kind of bought and sold a few times, and so that might be a decent one to look at also. That I thought was decent. It's just tough, right? Like it's tough when you're like in that space in particular, they're trying to tackle both the outside and the inside. And you kind of end up in a difficult you end up having to like do fulfillment from like RDCs that are designed for a different, real estate footprint. And but anyways, yeah, it could be an example as well.
Mhm. Hey, Shawn, was there anything unique about Build Direct that attracted you to the business?
I gotta say, I've said this probably a few times, but I felt like I bought I just like, you know you bought a house, you open up the garage, and there's this like beautiful vintage vehicle in there that you had no idea was part of the deal. That's what I felt like when I was going through the decks almost 3 years ago now for Build Direct. Just, I mean, first off, documentation was great, insiders are great, board was great, and I'm going through and looking at it with just from a pretty excited perspective because the sourcing model they had figured out and it's coming from a former depot merchant. And I was in Mohawk, huge company in the flooring industry, manufacturing. And I'm thinking I have like a lot of expertise in when it comes to like direct sourcing. No, what Build Direct did was way better. way better. And so it was fantastic there. The second piece is on the e-commerce side, they did it way better. Our conversion rates, even back then when that business had some challenges on fulfillment, were just at a level I never thought was possible. And so the company, like, in all seriousness, had a lot of things figured out in a really interesting way. And then the challenges that it was going through, which, there's some challenges we had to work through, but like with any great vehicle you're going to use for a consolidation play, if it was already perfect, you wouldn't be able to hop in and drive, right? It'd already be across the finish line.
Yeah.
And so I would say that was on the flip side, it was interesting because there's some things that were a bit off, like on fulfillment, that were, kind of a byproduct of that, for sure. So I would say that's probably like how I would view the company. It had some things really figured out, that were really expensive and very difficult to replicate. Like if you start a new flooring business online, have fun. You'll probably spend 30 some odd $1 million building up the domain authority and efficacy that we have, kind of from this point forward. And that was what really attracted me with the vehicle. That plus like really supportive, strong, healthy insiders who had a passion for what we were building, and just wasn't really questioning the industry. It was more of just having the right team that was doing it for the right reasons, right? Like, so our current team, we have a lot of passion for the flooring industry, the omni-channel deal. We love our M&A approach, and I think that's a big part, as well as having a long-term minded team.
Gotcha. Okay, we'll try to wrap up with the last few questions here. Are acquisitions debt financed? If so, what are the typical terms of the debt? How much leverage does management feel is appropriate for the business? Why don't we leave it at that, and I can give you the second part of the question.
Yeah, so I would say there, since they're mostly assets, right? Like just inventory that's current inventory. Rephrase that. Yeah, so debt. Ideally, like for us, like models, like models that you can use debt to finance, and then balance out, on the other side if you need to. Um, uh, so like we have covenants, right, with RVC, 3x coverage there. If I go back to my line before, pigs get fat, hogs get slaughtered. So when it comes to like we don't have to be overly aggressive on that side for what we're doing. You just can still have fantastic, phenomenal returns. And so I would say, like, when we were pulling the team together, we were pulling the right team with that mindset together. So yeah, that's kind of how we look at that part. What's the next part?
Well, it says, what type of assumptions does management use when stress testing the earnings power of the business?
Okay. So probably the biggest one is going to be on concentration risk for customers. So if I'm looking at a business, and you have like your customer list and percentage of what they're contributing. Look, if it's over typically 5%, we're taking off half. If it's over 7.5, it's zeroed out. And so just because typically the large customers are tied to the owner or the idea of the owner, right? Like I met you 20 years ago.
Yeah.
And so we take that off the top. And for the most part, like you have to have a business where sales drop down, about 15-20%, and it's still a great return because it's variable cost. The second thing on the procurement side, not so much, because there's the only thing you could do there, like when we were doing on modeling, I mentioned before, we model pre-synergy and we don't do deals off of synergy. Can't stress that enough. That's like the name mistake number one in my, my opinion. And so we don't permit that when we're doing modeling. So if we view that we have a hard synergy, that there's a 10% cost out on materials or XYZ, fantastic. We sign the team up, myself, for that. We'll knock that out, but it's not in the financial model.
Gotcha. Yeah, makes sense. Okay, Russell asks, do you offer an online or in-house vision of how the floor would look in the customer's home prior to purchase? visualizers. I don't know if you use that term, but we know of another company that offers sort of visualizer software. Is that something that you guys use?
Yeah, we use a company called a third-party company called Roomvo, which is kind of like the standard for the industry. Um, it's great. Gets used. You know, it's interesting. Like it's something you think everyone would use for every purchase. They don't. But it's a pretty good feature, easy to use, and we have the same thing.
Fantastic. Gotcha. Um, so I'm going to ask it anyways. Rahil says, sorry if this question has been asked before. Could you please share your thoughts on today's news release on management receiving the loan to buy company shares? Yeah, we just talked that through, Rahil, so that's been covered. Maybe, Shawn, I mean, what excites you the most? What sort of, let's say, initiative or thing that's coming down the pipe do you think gets you the most excited?
Yeah, so I would say the especially with the most recent deal, like seeing the team hop over from the build in Los Angeles, then right over to the buy, then renovate in Orlando, and then I'll stop there as far as their next plane tickets, right? That part, it's great. It's just
Mhm.
great. Like it's got a lot of good folks, good skill level, a mix of outside experience
Mhm.
and inside. It's pretty cool. Like we were pretty. I feel like this is a bold statement with this group. Great group, but I think we're pretty early adopter of AI tools. At the company across a
Mhm.
lot of fronts. And so like the ability to just speed up and use like the old M&A was you have to like as you go through a process to process through like one sim or one group of financials. Now you can do like 20
Mhm.
and you can get the answers and comparisons fast. That kind of stuff just make kind of can nerd out on that quite a bit. And we have like things that we're doing in channels that we're tapping for like lead gen that didn't exist 6 months ago.
Yeah.
And I feel like although I'm talking about it a lot, I personally think companies should openly leadership talk about how they're using it amongst their team, and then hope no one else does in the industry. I hope they're don't adopt it. But that's what gets me excited is the ability of doing new things faster
Yeah.
and better to a much better degree that
Mhm. Gotcha. And then, as if you were in our shoes as investors, what do you think are the most important either catalysts or metrics to pay attention to going forward?
Yeah, so I'd say, the first big one would probably, be the boring one, which would be EBITDA. Like
Mhm.
we posted last year. I've kind of teased out what is platform. Like the legacy financials were a bit tough the way they were structured. It was hard to like tease out what's platform, what's not platform. I could say the corporate platform costs have come down remarkably since we started the process a few years back. And so I would say kind of first and foremost, like holding that true, right? So
Mhm.
we're working on helping to make that more and more transparent, easy to model, because we really want to have financials. I want to provide the same type of financials that I want myself with to model. And so
Mhm.
that's been a big part and focus for our CFO to get done ideally this year. So I would probably say that, like being able to see how that's tracking with the platform cost relative to the buys. And we did announce like one large, like so you have last year pulling into this year, and then you have a large cost savings we announced back in, it's been a minute now, I think February. It's like annualized 900,000 US.
Mhm.
From an investment perspective, like, hey, you announced that, does it hold true on the results as it kind of flows through? Because like for us, that was the last big reduction on not on waste necessarily, but
Mhm.
on functions. I don't like big corporate support groups. They usually just burden a company down. So that was effectively a cut that we wrapped up with when we were done integrating those things using mostly technology and back into the businesses. And so I would say like, us holding true to that statement that we have a very, lean, fixed core platform, and money is being spent towards the additional locations, build or buy. And the DNA of those deals are mostly covered in assets. It just look, if we do that, it's great payback, fantastic payback. Scales very well, and the arbitrage is great. And so, just hopefully it's a steady deal.
Gotcha. Well, listen, I mean, this has been great. I certainly learned a lot from this. Shawn, is there any key message, key takeaway you want to make sure everybody walks away with today?
I would say, yeah, first and foremost, like for us, we're nested in a pretty large TAM, a very stable, low, um, like it's not like a super innovative, changing, patent pending category. So for us, it's a great exposure to housing, which is a huge market in North America, but more importantly, not on the construction side. Rather, our company gives you exposure to residential remodel, that the whole space. And then for us, it's literally just a capital allocation driven play. And I think if you're focused on the right things, mostly asset coverage on deals, it can be very very accretive. And so that's just how we think about things in the backdrop of everything we do. And that's kind of who we are as a team. And we're pretty thrilled to have folks like yourself following the story.
Fantastic. Well, listen, Shawn, thank you so much for joining us today. This has been great. We've been speaking with CEO Shawn Wilson, Build Direct, symbol BILD on the Venture Exchange. Shawn, look forward to catching up in the future and continued success.
Thank you very much. Take care.
Thank you. Bye for now.